Good morning. My name is Emily Davison. I'm the training coordinator for the South Carolina Small Business Development Centers. We are so glad you are here to join us this morning. In just a second, we're going to let Rick get started, but I wanted to let you know that we do have a survey that we'll be sending out at the end this helps us with our programming. So if you could take a moment and please fill that out, we would greatly appreciate it. And without further ado, Rick.
All right. Good morning, everyone. My name is Rick Vanderwill with the South Carolina SBDC. We are so thankful that you are with us today. We have a lot of ground that we want to cover, um, helping you as you in your journey of either launching your business or growing your business as well. We're looking forward to imparting a lot of information. Um, as we go through the presentation, if you have questions along the way, please feel free to put them into the chat box. And at the appropriate times, Emily can stop us and we can answer as many questions as you have. All right. So at the SBDC, we provide the tools, the training, and the resources to help small businesses grow and succeed throughout the entire state. Our mission really is quite simple, and that is to advance South Carolina's economic development by helping entrepreneurs grow successful businesses, both in the short term and in the long term. Okay. We have 20 locations throughout the state. I am personally based with the University of South Carolina here in Columbia, and we are also partnered with three other premier universities, South Carolina State in Orangeburg, Clemson, and Winthrop University as well. So no matter where you live in the state, we have consultants in all 46 counties that can help you in a variety of ways. Part of the SSBCI team here in the state. We'll talk about that a little bit more later on. But we provide three levels of technical support for startups and small businesses throughout the state. The first is financial counseling and loan packaging, help you to establish banking relationships, provide advice on financial management, talking about access to loans and how to go about that process to get loan ready to submit a loan application with business planning and financial projections and so on and so forth. We also provide accounting and bookkeeping guidance. We do not do your bookkeeping or accounting for you, but we are able to help you get your chart of accounts set up. Making sure that you have good records to create your financial statements. Many times we continue to work with our clients that are in business to review their monthly or quarterly or annual financial statements together, right? And then we're also able to provide some limited legal assistance. We are not attorneys by any way, shape, or form. However, we can help you guide through the process of creating your LLC, getting registration for various states and local to get a business license and registrations and certifications. We are also connected with the University of South Carolina Law School and the law firm of Turner Paget, where sometimes a client will have a specific legal need. For example, I'm about to enter into a loan agreement, or I'm going to sign a contract to lease a building. We can provide some no-cost legal advice to help you understand what the terms and conditions of those loan agreements are. Okay. All right. So the services that we offer, right? And you see, this is a broad brush of the services that we offer at the SBDC. At the heart of what we do is we are really a teaching institute. We do not necessarily do all the work for you, but we provide the tools, the training, and knowledge, and the resources. The heart of what we do is we provide no-cost, one-on-one business consulting. We spend a lot of our time with clients, either in person or in Zoom, helping them to develop their business plans, financial projections, market research, so on and so forth. Help with capital acquisition. And my guess is that's why a lot of you are here today. How do I get a bank loan to either start or to grow my business? Financial management as well. accounting, and bookkeeping. And lots of training and workshops and seminars, just like as we're doing today, right? If, for example, that you're looking for marketing assistance, or you want to get a SAM registration to be able to sell your products or service to the federal government or international trade, we have a lot of experts here within our SBDC team that we can co-consult and provide you with a lot of that training and education as well. Okay. A little bit about myself. There's my picture. I've got over 40 years of experience. I've been blessed with a great career ranging from the president, CEO, and CFO of several mid-sized manufacturing companies, from startups to turnarounds. I'm a certified business consultant, both in the state of Michigan and now here in the state of South Carolina. My background ranges from electronic control panels, whether it be touchscreens, integrated keyboards and keypads, to casework. And the last company that I had the opportunity to run is something that you see most every time that you're in a Walmart, a Kmart, a Publix. Company was called Amigo Mobility International. And right when you walk in the door, you'll see it. We manufactured and serviced throughout North America the battery operated shopping carts and other mobility devices. So kind of a little bit about myself there. All right. So let's get into the heart of what it is we want to accomplish today. And again, well, there's our team, right? We've got 5 people throughout our entire team. I'm right in the middle that covers the Midlands area. David Doherty on our far left covers that area. Richard Pilston, the Spartanburg. Joyce Black on the top right takes care of the Florence area. Unfortunately, Charlie, that you see in the Charleston office, just left us a few weeks ago, but we are currently in the process of filling that position and hope to have it filled soon. All right. So, part 1, kind of go through this, and then we'll take a 5-minute break later on. But we want to start with, types and sources of financing, i.e. capital, what we mean by traditional and non-traditional financing, and then spend some time talking about the lending process, what's all involved, and some of the myths and some of the realities associated with that. You may have seen the movie, Jerry Maguire, Show Me the Money, right? So, as you go back to your either high school or economics classes, college economics class, right? There are 4 factors of production, and you see the first 3 here, right? Land, which are the natural resources to create the goods and services. Labor, effort expended to bring those goods and services to market. In entrepreneurship, that's all of you and your management team making it all happen, right? And the 4th one, probably not a big surprise, is capital. Capital is a fancy word for cash. Cash that is being put to work to make productive or investment purposes. It is a critical component of running your business, right? Interestingly enough, 70% of businesses that fail in the first 3 years of operation tend to be because they do not have enough cash, whether to handle growth or to handle downturn, right? So cash at the very beginning of starting your business is incredibly important. There are 2 types of capital. There is debt and there is equity. And the numbers you see here, the 40 trillion and the 20 trillion, basically the small businesses throughout the entire country. Right? And let's just spend a few minutes talking about the various types of that. The first one is debt. Very simply, it's money owed from one party to another, typically paid over time. It could be short-term or long-term. Think of short-term if you have a car or a truck loan or a computer loan. Long-term if you have a commercial real estate loan. It could be fixed or variable. Interest is typically tax deductible, and it doesn't have a claim on any future profits. Oftentimes, collateral or personal guarantees may be required, and that's really true, and we'll talk about that more later on for small businesses. On the equity side, that is kind of, if you will, your skin in the game, what you are putting into the business to start or to run. Dividends are typically not required. Sometimes they are, sometimes you do it, but it doesn't have to be. Now you have a claim on all future profits and the value of the business. If you sell some equity, it does dilute your ownership, your equity. And it may come with a say in future businesses decisions based upon whether or not you have a management team that has ownership or a board of directors and so on and so forth. Right. Let's talk a little bit about the sources of capital. We don't have time to go through everything today, but we want to, talk about some of the highlights. And you'll see, E, D, and G, equity, debt, and gifts, right? First one is personal savings and bootstrapping, family and friends, commercial banks, community banks and credit unions, micro lenders, and community development organizations that tend to be nonprofit organizations that provide loans and investments and counseling to very specific targeted individuals and communities throughout the entire state. We're going to spend a little bit of time talking about the State Small Business Credit Initiative program that we offer, SBA, and the whole other in terms of venture capital, seller and supplier financing, fintech, collateral-based, crowdfunding, and peer-to-peer lending as well. There's a large list of these, right? So let's start with sources of capital, okay? Three things I want to point out here in this graph. As you see on the left, between large banks and small banks, 73% of small businesses get their financing through what you would call traditional banks, okay? Now, also need to understand here is that a small business is defined as 500 employees or less. So that's a big number in terms of number of employees inside of a company, okay? Interestingly enough here, one of the things that really surprised us when we got this information from the Federal Reserve is that 22% of small businesses are getting some sort of financing from online lenders. Now, that has just mushroomed over the last couple of years. It's not to say that's necessarily bad. However, online lending is a little bit tricky and it is very expensive. Right? Where you might be looking at, say, a 10 or 12% interest rate from a bank or a credit union. Oftentimes, online lenders are 20% or more. In fact, I am working with one client today on a whole debt restructuring package where his business has about 4 or 5 online loans out there, and they're paying anywhere from 20 to 25% interest rate, and that's very expensive. CDFIs, well, it only has 4% on a nationwide. That is a great source of lending for many of our clients here in the state of South Carolina, and we'll be spending a little bit more time on that later on in the presentation. So let's talk a little bit about traditional and non-traditional financing and what are your options. In terms of traditional, it's pretty simple. It's financing obtained through a bank or a commercial bank or a credit union. And non-traditional is pretty much everything else. Traditional financing is great if you qualify and if you have the patience. Commercial banks offer a wide range of services, fixed and adjustable loans, lines of credit, credit cards, commercial real estate loans, and the like. Community banks and credit unions pretty much offer the same sort of thing as a large commercial bank, but they tend to be more community focused, where if you go to your local branch, oftentimes the branch manager is a small business lender as well. Where if you're going to a large commercial bank, you may be not may you may not be talking to somebody in person. It could be all online. Okay. Something that kind of straddles the line would be the Small Business Administration SBA loans, some micro loans, and venture capital. Venture capital is typically reserved for really fast-growing companies that can scale up very quickly, and then they have a high likelihood of being sold or exit in a 5 to 7 year period. Little thing about, SBA loans, and we'll talk about that more as well today. 99% of the SBA loans are not, the SBA does not actually lend the money. They serve as a guarantor, kind of like you think of an insurance agent to a bank or a CDFI. Okay. So we talked about here, we have in bold, we're going to be spending more time on those, the community development organizations, the state small business credit initiative, and microloans as well. We really don't have time today to go through all the others. However, upon completing your survey, we do have a couple handouts that we can send to you as a PDF. All right, so let's kind of talk a little bit about the lending process and what's all involved. Okay. First of all, I want to back up a little bit, and please bear with us as we kind of go through this. Is what is a bank, right? A bank is a licensed institution that accepts deposits and makes loans. It's a business, right? It brings people together, that those that have capital and those that need capital, right? So banking 101, what business are they in, right? So think about, these questions. What product or service do they offer? How does a bank acquire it? How much does it cost them? And what do they charge? Yeah. Banking is all about money, right? Banks take deposits. We go to a bank, we put on we put money into a checking or savings account, our direct deposits. That's a deposit that the bank can then turn into a loan. Banks are all about maximizing the spread of their costs and their price. Thinking about your business. Your business is much the same way. Maximizing how much you can charge for that service and what your costs are, right? So bear with me as we kind of go through a mini case study. And again, I want you to think about, this is not too dissimilar of how many businesses run. While we're talking about money and banking, whether you be in manufacturing, a restaurant business, oftentimes it works in similar ways as well, right? So a bank, it gathers your deposits. By law, a bank has to put 10% of those deposits into reserve to handle the daily inflows and outflows when you make a withdrawal. A bank then can lend 90% of those deposits and loans. Let's say it earns 8% interest rate on that loan. From there, they pay their employees, their overhead, their taxes. They pay us, not much right now, 1%. And that's kind of the cycle how a business works. Not too dissimilar, as I said, how many businesses operate and run as well. A key metric that banks, and hear that on Wall Street when they have their quarterly or their annual earnings release, is net interest income. And that's defined by how much interest they earn versus the interest expense that they pay to folks like us. The more deposits, the more money they lend, the more interest income that they earn. Okay. So think about a little bit of myth or reality. Okay. Question number one. Banks really don't like to lend money or only lend money to companies that don't need it. You hear this a lot at times, right? But honestly, folks, the reality is a bank would like nothing more than to lend 90% of those deposits out. That's how a bank makes money. Now, they're only going to lend money if they have a high level of confidence that the borrower is going to make those monthly or weekly payments on time and in full, right? But banks are in the business of lending money. Second question. Banks don't lend money to small companies and startups. Well, that honestly, it's kind of a yes and a no here. Many large banks do not lend to startups or small businesses. That just isn't their cup of tea, right? A lot of small banks, community banks, if you will, credit unions, CDFIs have more of a greater appetite to take some risk um, to lend to small businesses. Online lenders aren't trustworthy. That really isn't the case that they aren't trustworthy. However, as I mentioned earlier, interest rates are very, very high. It's a very, very expensive source of financing. And most of it is just like it says, online. So it's very difficult to talk to somebody if you have a challenge, if you have an issue. Obtaining a small business is a long and arduous process. Well, it is a process. It can be long, but working with somebody like us with the SBDC, we can help expedite that. At the same time, once a loan application is submitted to a bank and you've crossed all of your T's and dotted all of your I's and you got the whole package together, it typically takes anywhere from 45 to 60 days to closing. It is a process. And you must have a high credit score to get a loan. Well, yes and no. Most banks, commercial banks, are going to be looking at 650 or higher. Some CDFIs and community lending organizations might be a little bit lower, but 650 is generally the minimum that you need to have. All right. So let's talk a little bit about the process. You as a borrower, thinking about, okay, I want to get a loan, right? And as you see, I put in here startup capital dollars in red, and I've got a line through it. We urge you not to go to a commercial bank or a lender, a credit union, and say, I want money to start my business. I need $75,000 or $100,000. Okay. That doesn't tell the lender anything. You really need to be specific and do your homework and do your planning. What is the money actually going to be used for? Right? Do I need to buy some machinery and equipment? How much? Looking to buy some computers, software, office furniture. Am I going to be leasing a building where there's some leasehold improvements that I need to make to the facility to get it ready? Is there some rolling stock that I need? Cars, truck, forklifts? How much am I going to need for inventory and supplies? What about working capital, the ebbs and the flows, right? So as we work with our clients and put their business plans together, their financial projections, we put the loan application in and we're talking with the bankers, we will have anywhere from 5 to 6 numbers, and we want to spell out how much do we need for working capital? How much do we need for machinery and equipment? How much do we need for inventory and supplies? Because you may have a short-term loan with that bank, let's say for software and equipment. You may have a longer term loan if you're buying a piece of real estate, right? So we want to make sure as we go through that process that we have a good match of the capital, the source, we match the assets and the liabilities. Oftentimes, while you may have a, let's say, $75,000 loan with the bank, it's broken up into little pieces. X amount for real estate, X amount for working capital, Y amount for, let's say, cars or trucks, because we want to make sure that we have the good match there. Okay. And also the borrowing capacity. How much are you able to borrow? Moving along. So, what is the process? Okay. First of all, banks or any financial institution is going to require a business plan and financial projections. And you've come to the right place that's one of our core capabilities that we work with all of our clients in the state. We're not going to write the business plan for you, but we have a lot of tools, we have a lot of resources that we can work with you to develop your written business plan. If you are a startup or only been in business for a short period of time, they're also going to require financial projections. And honestly, financial projections are really more important to you initially than they are to the bank, because we want to work with you to make sure that you have a good understanding of the business. How is it going to monetize? What are going to be, what are some shortfalls that we need to take into consideration relative to seasonality of the business? As all businesses don't sell the same amount month after month, year after year, right? For example, when I was in the SBDC in the state of Michigan, worked with a gas station, a 24/7 convenience store. Well, it's cold in Michigan, right? So as we put our business plan and our financial projections together, revenues could vary by 50% on a month-to-month basis. In the wintertime, sales were very, very low. Summer, it was much higher for pop and beer and those sorts of things. So we had to put that all into our numbers. And the same thing happens in South Carolina, right? You have some seasonality, and we like to do this on a very detailed basis where we will work with you. Our consultants do a lot of the legwork in that, where we will develop a 3-year detailed monthly financial projection and help guide you through that entire process. Okay? Personal and business tax returns, personal financial statements. If you're in business, your business financial statements and tax returns, personal and business credit reports. Right? So now is the time to start to put a lot of that information in items 2, 3, 4, and 5. If you're going to go to a bank, and we'll talk about again this later, it's going to be required. So let's say you're looking to go to a bank and working with us that, maybe 3 or 4 months from now, you're going to be ready to submit that loan application. Now is a great time to start to gather that information. So when the time comes, you're ready to go. Let's talk about it from the lender process, right? I often tell my clients that I'm working with, if we're looking to talk to submit our loan application, let's say in 30, 60, or 90 days, now is the time to start to develop a relationship with a bank or a credit union, a CDFI lender. We're very happy to make introductions, meet in person, or Zoom with that lender as well to develop a relationship. Let them know what's coming, what type of business my client is interested in. Because some banks, may not be interested in a franchise or in a gas station or in a restaurant. We want to learn that early on in the process so we can develop a list of 3 or 4 banks or financial institutions that we want to talk to. Right? So as we talk to that bank or that lender, discuss what our needs and determine, as I said, are we eligible? Do they have an interest in our type of business? Right? As I mentioned before, we gather all the needed information. Right? Once we get all of that done, we submit the loan application. Okay. And many times, I'm probably going to say 95% of the time, the lending institution isn't even going to look at your loan application till everything is completed. You got to cross all of your T's, dot all of your I's, making sure that you have everything correct and 100% completed. I'll give you an example. Worked with a client last fall that is looking to start a daycare center. A lending institution, really, really excited to work with this client to finance it, right? We submitted 99% of the loan application. They were waiting for an email from one of the spouse's HR department for verification of employment. Even though our client provided the tax return, provided updated payroll stubs, so they had all of that, they would not start reviewing the application until they had that email from the employer. Unfortunately, it took 90 days before my client was able to get their employer to finally send that email. So nothing happened for 90 days. So that's why it's so important that as you meet with the lender, you get the list, what's all required, and start to put all that information together. Okay. So let's talk more of the positive, right? You got the loan submitted. Then it goes to underwriting. Underwriting at a bank is a department. People think about it's a secret department, but it really is a group of individuals that now are going to dissect the loan application. Does the business plan make sense? Are the financial projections reasonable? Have they thought about the what ifs? They will delve into your credit score. They will do background checks. They will do, as the application full and complete, much as like when you apply for a mortgage application. They go through that entire process. Hopefully, you'll get a conditional approval, perhaps a denial, or it could be, hey, we need some more information to go through. Once it's approved, you'll get a letter, you get a conditional letter, and then go through some of the documentation, and then hopefully you have closing and disbursement. And again, as I mentioned, if everything goes well from the time that a loan is submitted and things go smoothly, it's about a 45 to 60-day process. Going to talk a little bit about some of the language of lending. And again, upon submission of our survey, we'd be very happy to send you some of these handouts as well. APR, annual percentage rate. What is the annual cost of a loan, which is a combination of the interest rate and any other fees or charges that the bank or the lending institution may charge? Are you going to be a co-borrower or a co-signer? The co-borrower is a joint applicant and shares in the ownership and the responsibility for repayment on the loan. In other words, you're on the hook. The co-signer is someone who's only liable if the primary borrower fails to make the payments. So I'll give you a couple examples of that just for myself. When my son was going to graduate school. He took out a loan for grad school. I had to be a co-borrower. So if Eric wasn't making the loan payments, I'm equally on the hook. When my other daughter went to law school, she took out a loan for law school. On that particular thing, I was only the co-signer, right? So if Megan didn't make the loan payments, which she did, by the way, then I would be on the hook. So you want to make sure that you have a good understanding if you're signing something there, right? What is a term sheet? It sets forth the terms and general conditions of the loan or the credit facility. If you get a commitment letter from the bank, it's a legally binding commitment from the bank that has the general terms and conditions. And then you have the actual loan agreement, which is the contract, just like a contract for a mortgage. It's the loan agreement contract that spells out all the details. How much is the interest rate? How much are the monthly payments? Is there a prepayment penalty? All those sorts of things. And as I said earlier, we are not attorneys, but once you get to the point where you are looking at a loan agreement, we often recommend that you retain an attorney to making sure that you have a full and complete understanding of what you're signing. Personal guarantee, all right? An individual, typically, it's the principal, the owner of the business, or a group of owners that promise to pay the loan. It could be oftentimes it's a pledge of your personal assets. By pledge of personal assets, we mean you're putting your home, your retirement plan, right, as collateral. Your credit score, and again, we'll be talking a lot more about this later on this morning and this afternoon. Credit score is really a mathematical derived number. It started by FICO in the late 1980s that predicts how likely you are able or willing to pay a loan back in full and on time. There are both individual and business credit scores, although for small businesses, it really is more largely geared on the individual basis. Loan amortization. Think about it as a mortgage, right? What is the breakdown between the principal and the interest on a loan? Then you have a guaranteed loan. SBA, there are some, USDA loans as well, but largely SBA loans for small businesses that guarantee in case there is a default. And you want to make sure that in any loan application any loan that you sign in, is there a prepayment penalty? If you're in the position that you would like to pay it off early, are you able to do so without any costs? Next is a bit of a complicated number. It's called the debt service coverage ratio. This is a key number that a bank is going to be looking for as they review your actual financial statements or your projections or a combination thereof. Really kind of ask the question, is the business generating enough profit to pay the loan and the interest back on a monthly, quarterly, and annual basis? And when we work with clients, that's a key performance metric that we provide, and we work with you as well. Pro forma financial statements. Basically, they're projections. We love to work with our clients in putting detailed regional projections as they look to either start their business and to grow their business. And, I often tell clients that it really becomes a reality. You never get it right the first time you do the first draft of a financial projection. It typically takes anywhere from 6 to 10 drafts of us working together to think, boy, we got it about, that's reasonable. We've taken into consideration seasonality, lots of variables, lots of what ifs, and we meet on a regular basis to go through that entire process. It's something that I really enjoy working with, and our clients at the end of the day, it gives them a much higher level degree of confidence, right? that what they're looking to do can be accomplished, right? And then you have your personal financial statement, kind of like a business balance sheet, right? What are your assets? What are your liabilities? In any loan application, you're going to have to provide that. How much do I have in checking and savings? What's the market value of my home, my car, retirement savings? What liabilities do I have? Do I have some taxes that are owed? Credit card debt, student loan debt, mortgages, so on and so forth that have to be divulged, right? We're about halfway through. We've covered a lot of ground so far. Hopefully, it's not too confusing. Are there any questions that we can answer at the present time?
Okay, so we have a couple of questions.
Okay.
So the first one is, does SSBCI partner with nonprofits offering workforce readiness programs?
The SBDC and the SSBCI, we are only allowed to work with for-profit organizations. If this is nonprofit, we would typically, recommend that you contact, for example, South Carolina Community Works, or SCORE as well. Might be a very good resource. But here at the SBDC, our mission, and we can only work with for-profit organizations.
There are some loopholes there, but I am not familiar enough with it. I just know it has to do with economic development. So that's definitely something that you should talk to your counselor about.
Okay.
So hello, is this being recorded to share afterwards? Yes, we are recording this to share. If you would like your name on the list, you are welcome to send me an email, and I'll add you to my list of people to contact. So can SSBCI services be bundled with SBA microloans for community education initiatives?
Can you repeat the question, Emily,
Yes.
please?
Can SSBCI services be bundled with SBA microloans for community education initiatives?
That's beyond my pay grade, but I believe that, talking with somebody with inside of our state director's office, we very well may be able to accomplish that.
We can definitely get you sent to the right person.
Yes,
Send me an
absolutely.
email.
Yep.
All right. So, next question. So, a business has started with something small, let's say like a business cell phone plan. Assuming the business is registered with Dun& and Bradstreet, does that build credit? How long does it take to show on a credit report so future lenders will see a credit history?
With D&B, I believe it goes pretty quickly. Establishing your credit in the right way, in the right form, makes the most sense. Oftentimes, well, as I mentioned before, there are individual uh, credit scores and business credit scores. Most of the time with the banks and the credit unions and the various lenders that we work with, they're really more focused on the individual credit score than they are on the business credit score.
Okay. So, next question is, will you share the slides after the presentation? We can definitely do that as long as you're okay with it, Rick.
Ah, yes, absolutely.
I can share those slides. Okay, so next question. I'd like to speak to someone about getting my business plan set up. So,
You come to the right place.
yes.
At the end of our time together, we will send you, or on the screen, we'll have some information. It's very easy to sign up because you are here today. Emily can help as well. It only takes a couple steps, and then you can be assigned to one of our SSBCI consultants within probably 2 or 3 days. One of us would be able to reach out to you and set up an initial meeting. We typically do that via a 30-minute introductory Zoom call and get the process started.
Yep.
We'd love to work with you.
Rick, how far out are you booking for consults?
Usually, depending upon, honestly, Emily, it varies by week. Pretty much booked rest of this week during travel. If somebody would sign up today, um, I could probably meet with them sometime next week, Wednesday or Thursday. It doesn't take that long at all. We're not talking weeks, that's for
Okay.
sure.
Because the next question is, I currently have a meeting today with a bank for a business bank account, maybe even financing. I was wondering if there are any available meeting times for consulting today.
Unfortunately not. I'm sorry. I'm pretty much booked for the day. And again, our process that we would like to go through is, walk you through the process, get a good understanding of what it is you're trying to accomplish so we can provide the right tools. There other consultants may work, in a different form or fashion. So it isn't one isn't right or one isn't wrong, but I tend to take it a little bit slow. Again, I've got 40 years of running companies and owning companies. Is making sure that we cross our T's, we dot our I's versus just going, boom, let's try and get something done. Okay.
Okay. So the next question is, if we already have a business plan, can you all help review slash augment?
Absolutely.
Awesome. Okay.
Yeah, absolutely. We'd be more than happy to review your plan. Whether you're looking for financing and using your business plan for that, or perhaps, your financing, your operations are all set. Let's say you're updating your strategic plan or your business plan for the next year. You would like another set of eyes to give you some ideas or thing, yes, we'd be happy to do that. And again, everything that we do is at no cost.
Okay, so there's two questions that are basically, how do I sign up? I'm getting ready to put the link in the chat. So just know that's coming, you guys. I would have another question, and I'm pretty sure I can answer this one if you don't know the answer, Rick. It says we live in Pennsylvania, own a second home in South Carolina, and we'll be moving to South Carolina in 2 to 3 years. We want to start a business in South Carolina, servicing rental or owners remotely at first and then in person later. Can I continue to get counseling with your organization? So I know the answer to this because I had to talk to someone about it the other day, but I didn't know if you knew the answer, Rick.
I do not know the answer to
Okay,
that.
so the answer is yes. If you live out of state, but
Okay.
you are planning on starting a business in South Carolina or growing a business in South Carolina, we can help you.
Okay, very good. Great. All right. So let's continue on for the second part of our conversation today. All right. So part two, funding your business. Kind of a brief overview of the what, the why, and the why nots of various types of financing. Honestly, we don't have time today to go through everything, but we'll really focus on some of the core. I want to spend a little bit of time on everybody's favorite topic, credit, right? What it means, why it's important, and what are the factors of the what we consider to be the 6 C's of credit. And then for the 75% of you that answer the polling questions that really don't have that good of an understanding of the big three, spend a little bit of time talking about the financial statements, why they're important, what they are, and again, we can help you through that entire process as well. So, various types, all right? Now, the first types of financing is personal savings, bootstrapping, family and friends. Honestly, 75% of small businesses throughout the entire country get started with simply this, right? They're not getting outside financing, maybe they can because they can't, but it starts with your own money, your own skin in the game. The advantages of that obviously are pretty straightforward. You don't have any debt. You're able to maintain, control and flexibility. And as I mentioned, perhaps you're just simply unable to get bank financing as a startup for a variety of reasons. But why not? Is it certainly can limit your growth, right? Because you're not able to grow and expand as quickly as you would like. You put in your personal capital at risk. And then it could be awkward with family and friends. If you're borrowing money from your parents or your grandparents, Christmas and holidays could get a little bit tricky. That's why we always recommend that if you are taking a loan from a family or friend, a family member or friend, you do it in a very professional manner. Make sure that you have a detailed loan agreement, cross the T's, dot the I's, so on and so forth. Okay. All right. Then you have our national and super regional commercial banks. Some of the big ones around here would be TD, Truist, Wells Fargo, Bank of America. Why you may want to do that? But obviously it has lower rates than non-traditional sources, right? You have the opportunity for better terms and access to a lot of other services in terms of payroll processing, check deposits, credit cards, so on and so forth. But why not? Especially as it relates to smaller business and startups, is they got more stringent credit standards, extended approval to timeline for approval. And then you see that number on the bottom right at 7%. Okay. Only 7% of small businesses that start, either startups or in their first 2 to 3 years of operations, get their financing from a national or a super regional commercial bank. Oftentimes, the big guys and big girls really don't like to work with small companies. Too much risk. Also, it's just not their cup of tea. For example, I was working with a client here in the Aiken area to get financing for about $100,000, and we went to one of these larger banks here, you see, and had a great business plan, had all the collateral, everything else. It really was a slam dunk to get the loan approved. However, this particular bank said, we don't really like to touch anything less than $100,000. It's not because your client doesn't have a good business model. Everything else looks great. It's just that our cost to go through the whole approval process and to documentation, the loan underwriting, it costs us the same amount, whether it be a $100,000 loan or a $200,000 loan. Just the loan was simply too small. We did get it financed with a community bank that loved that because that was simply a great fit. Okay? And we talked earlier about regional and community banks and credit unions. See some of the big names here or names that you'll see. First Community, which is a great organization, Optus in Columbia, South State, South Carolina Federal Credit Union as well, and there's many others. This tends to be a great source of financing for our small business clients because oftentimes they have a focus on local and community lending. They want to lend money to small businesses. That's what they're for. Get to use your deposits so they can loan that 90%. Just like a bank or a large bank, tend to be lower rates, have other services as well, credit cards, payroll processing, and those sorts of things. Same thing happens with just like a large bank. It has their credit standards tend to be a bit tough, could have some extended loan approval, and they may lack some flexibility. Again, it kind of is that in between, but again, it is a very, very good source for our clients. This one is a great application. Community development organizations. These are nonprofit organizations, ones that we have a great relationship in the state. Community Works, the Klein Fund, do a lot of business with them. South Carolina Community Loan Fund as well. Right? They look at a loan application much like a bank. However, they are really focused on startups and newer enterprises as well. Right? Still have to complete the loan application. They may not, their product offerings are a bit limited. And when I say that, they don't have credit cards, right? It's simply a loan, right? Some organizations might be capped. Maybe they can't lend more than 100 or $150,000, but honestly, probably 75% of the 25 clients that I'm working with right now today to get financing, only one or two are more than that 100 are greater than $150,000. So it really fits right into what these organizations are trying to do. A large number of our clients actually come from referrals from these three organizations that you see here. I want a loan. I want to start a business. Hey, I don't have a business plan yet. I don't have my financial projections. They send them to the SBDC. We work in partnership. A really good organization that we can put you in touch with when you get to that point in time, right? Then we also have what's called the State Small Business Credit Initiative Loan Program, a long term, right? This program is not for startups, right? As I think we've got about, Emily, as I recall, about 15% of the people that are on the call today. This might be a great application
Yes,
for
you
that.
are eligible if you are in an underserved community or in a rural area. Again,
That is exactly right. And I'm going to give a couple examples of how this process works, but we work with BDC, and BDC, which the Business Development Corporation based in Columbia, works in partnership with banks to help foster this program. Okay. Loan amount is is anywhere from 100,000 as a minimum to $20 million. It is a target market for socially, economically, and disadvantaged individuals and very small businesses. Very small businesses are defined for this program that have less than 10 employees. Since this program has been evolved a little more than 2 years ago, when I met with BDC last week, they informed me that they've already closed 155 loans. So this is a very active program. And again, as Emily said as well, it's targeted to the underserved areas and communities in South Carolina. It's offered through traditional banks and CDFIs. Startups, the answer is no, right? This is for businesses that have a successful track record. Most banks are going to be looking that you're in business for 2, if not 3 years, that you're growing and that you have a real need. And let me kind of walk you through how this works and the advantage of this program. It really is exciting when your business gets to that point. So here is what the program can be used for. For 51% owner or owner-occupied real estate, for real estate upgrades, commercial construction, so on and so forth, for equipment. And think about equipment if you're a manufacturer, you're looking to purchase a CNC machine or some welding equipment. If you're a dentist office and you're looking to expand, you need to get another dentist equipment and chairs or veterinary, those sorts of things. So wide range of equipment. Okay. It doesn't, however, apply to what's called rolling stock, trucks, trailers, and so on. Okay. The loans are actually written and serviced by the bank, not by the state. So it really kind of acts as a traditional loan. And I said, BDC participates. There's no additional cost to you as a borrower. Everything is handled really by the commercial lending institution. But let me give you an example. And this is and I say example, this is a real world example with a client that we are working with in the Newberry area. Okay. Think about it as a traditional bank loan. This client is looking to purchase about $200,000 of real estate to purchase the building that they've been leasing for the last few years. Traditionally, a bank is going to require 20% down payment of $40,000 and then $160,000 real estate loan. Again, that's a lot of money to put down as a down payment for a business, even though they've been in business for 5 years and doing pretty well. Honestly, they simply don't have that much excess working capital. In this program, BDC comes in and they help lend or buy, they lend to the bank an additional 15%. So again, you have the same loan of a 200, the same real estate, transaction of $200,000. Bank lends 160. BDC comes in at 15%, and you, the borrower, your down payment is literally only 5%, $10,000. For this client, that saves them $30,000 at loan closing. It may sound too good to be true, but again, if you look at that prior slide, we've closed with BDC working with the banks 155 loans. Okay, so it's a great program when you get to that point. Okay. Another option might be an SBA loan, Small Business Administration. The Small Business Administration's two primary loan programs are called a 7A, term loans and lines of credit, and the 504, which is for fixed assets, land, buildings, and large pieces of equipment. The SBA really doesn't lend the money, okay? They act, if you will, as an insurance agent or a guarantor to the bank. So let's say you've got a $100,000 program. The bank or the credit union or a particular CDFI is interested in the program, but there's a little bit too much risk that the loan underwriters want to take at this particular time. They may look to the SBA for a guarantee. Whereas if you, the borrower, default, the SBA will come in with a 70% guarantee to that loan. It reduces the bank's risk, right, where the SBA comes in. So that's why you might want to do it. They may have some more lenient credit terms or standards. However, very few startups qualify. These are really for businesses, again, kind of like the SSBCI program. Banks really more look to the SBA for companies that have that are in business for 2 to 3 years that have a good track record. Right? They have very strict collateral and personal liability requirements. Every SBA loan is going to come with a requirement that any owner or owners that have more than 20% ownership group have to requires a personal guarantee. There are more fees, and it tends to be anywhere from 2 to 5 points, interest rate points more expensive. So, for example, if you'd be looking at a bank right now with a 10% interest rate, SBA loan is going to be somewhere anywhere from that 13 to 15% interest rate. So it's a bit more expensive. Fintech lenders, not going to spend a whole lot of time on this just for the lack of time, but there's a lot of them out there, right? SoFi, Affirm, Cabbage, On Deck, and there's more of them. I think Rocket has some as well. Again, sometimes this might be the only option for some businesses relative to their financial condition, where they're at. Tends to be relatively quick. Everything is online. It's hard to talk to somebody, however, if you have an issue. It usually requires a direct deposit or direct payment. So you better make sure that you have money in the bank to meet that monthly or sometimes daily loan payment. And they're expensive. As I said before, working with a client in the Columbia area on a debt restructuring, it's 20% plus, and it is a very, very expensive way to finance. Sometimes credit cards might even be a little bit less, okay? Venture capital and angel investors. Again, we're not don't have a whole lot of time to spend on this. Typically, isn't so much for a startup or small business. These are more for high growth companies, private equity that have that can really grow. Think of a hockey stick that can grow from 10 million to $100 million in 2 to 3 years or 4 years, and they can exit. That's how these companies are able to make their return. Supplier and vendor financing. Honestly, this may not be a bad option for a company, or a startup, or a small business, where your supplier does some financing. Let's say you are in the t-shirt business. Perhaps your supplier of t-shirts might be able to provide you with some collateral financing. Tends to be a little bit more expensive, but again, those are options where they're using your inventory of t-shirts as collateral for that loan. Crowdfunding and peer-to-peer. Honestly, I don't have any experience in this. Um, we are happy to send this PowerPoint presentation as a handout. Those are options. Really, I just simply don't have any experience, but we did want it to list that. Seller financing, could be a good option for very specific things. Think of seller financing of you're looking to purchase a truck or a vehicle for your loan, right? There's Ford Motor Credit, there's GMAC. If you're looking for landscaping equipment, John Deere. Those are what we mean by seller financing, where the manufacturer may have some loan programs that you might be able to use to help finance. Might be a little bit more expensive than a bank. There again, if let's say you're looking using the landscaping example, that's the collateral that John Deere would have for your trucks, your trailers, and those sorts of things. Okay. Grants might be hard to read there, but I'll try and read it for all of you. The federal government does not offer grants or free money to individuals to start a business to cover personal expenses, contrary to what you might see online or in the media. Websites or other publications claiming to offer free money from the government are often scams. Report them to the Federal Trade Commission. Okay? Many times when one of our 5 SSBCI clients or counselors meet with the client, oftentimes the question is asked, are grants available? Okay. Folks, we are not in the grant business. There may be some grants that may be available, but that is really up to you to do that type of research, right? If, for example, you are in the agricultural business, farming, food processing, there are quite a few grants that may be available in that realm. We have a couple consultants within our state network that are experts in helping to write those grants and has been very successful in getting grant funding for egg types of projects. Understand though that oftentimes you don't get the money up front, right? Jim was telling me last week when I was at a meeting that he was able to work with a food processor somewhere in the state of South Carolina to get a $400,000 grant from the U.S. Department of Agriculture as they were installing a solar and other devices, if you will. I don't understand all the details to lower their cost of operations. Okay, so think about this. This was a $400,000 reimbursement grant, meaning, and it was a 50% $400,000 reimbursement grant. So this food processor had to put in $800,000 of their own money up front to get this whole project up and running. It was going to be 2 to 3 years until everything was in place and in operations so they could show to the federal government that they were able to meet or exceed the reduction in electricity costs. Once that was done, then they would get a $400,000 reimbursement. So again, that's a large example, but again, we are not really in the grant business. There may be some things that are available, but that's not really our cup of tea.
Hey Rick, real quick, while
Yeah.
you're talking about grants, because I have a master's in library science, and one of the classes we take is on grants. Grants are not giant piles of free money. It is money you're going to have to work twice as hard for. There are always stipulations. There's always things that have to be done. We've also had someone check in the comments saying to check with your local economical development office for available grants. You can also go to grants.gov.
Perfect. Yep.
And SCMEP, who is another resource partner of ours, we love working with them, is currently offering grants to build websites. Dominion Energy also regularly has grants available.
Okay, great. And that is great. Right. So, grants are very targeted, specialized, as you said. There are some that might be available. But again, USD, as I mentioned, perhaps Emily in the chat box, you might be able to list some of those organizations and websites that the folks here online today that can do some research on their own as well. All right, let's continue on. Everybody's favorite topic, credit. This C stands for credit, the 6 C's of lending. And as I look at the responses from our participants, which is great, 71% of you know what your credit score is. That's higher than most of the webinars and discussions that we have. So that's great. So let's talk a little bit about what are the 6 C's of lending. Okay. The first is your credit or character, right? Years back, way back, bankers, when they looked at character or credit, it was really their relationship with the borrower, okay? When computers became more widespread, in the 1960s, FICO, the Fair Isaac Credit Corporation, created the first credit scoring model. Based upon all parts of computer, logarithms, and those sorts of things. And that's what everybody, when they think about credit, they think about what is my credit score, right? Most conventional lenders, as I mentioned earlier, require a minimum of 650. In tough economic times, I think back to the financial crisis in 2008 and 2009, many banks required a minimum score of 700 because there were tougher economic times. Okay. But really, what it is the credit number, the credit score is all based upon your ability to pay your debts on time and in full every single month, every single quarter, every single year. Okay. Next is capital. A good way to think of capital is what is or how much is your skin in the game? How much money do you have personally invested into your business? Okay. Most banks, when we talk with our clients and we're talking with banks and credit unions and CDFIs, typically are going to require anywhere from 20 to 30% of owner's equity into the business. So, example, if we put the business plan together and we work in our financial projections, if you're looking for a $100,000 loan to start your business, right? You're going to need to put in through friends, family, equity, that big E, probably $30,000 or more. If you only have $5,000, honestly, that's not going to cut it. You need to have skin in the game. Okay? Third is capacity. How are you going to repay the loan? Does your business, if you're currently operating, or if you're a startup or emerging business and we're working on all projections, is your business profitable? Are you generating enough excess cash? Think about what I showed earlier, the debt service coverage ratio. Is it at 1.25%? That you have a high probability that you are going to be able to repay that loan on a consistent and a regular basis. If not, also as a startup, what other sources of uh, cash do you have available? You know, does your spouse or does your partner, does they have a good full-time job where they can be a backup or a guarantor, right? So it's not necessarily just on the business. If you're a startup emerging in business for just a couple of years, banks are also going to be looking at deep pockets, if you will, to make sure that there is a backup plan if things don't go as well as you would hope. Okay? And then part of that leads into collateral. Collateral is very, very important. You know, from the downside, it refers to what can be seized or sold by the lender if you don't repay the loan. That may include your house, vehicle, stocks, bonds, your 401k plan, so on and so forth. Banks are always going to be looking at collateral. What is that backup? And that kind of goes to, you know, your a personal guarantee. Uh, every SBA loan, I've only had one loan that I have worked with both in the Michigan SBDC and now in the state of South Carolina where a personal guarantee was not required. So plan on it. That's typically how it's going to work. Fifth is conditions. You know, so what's going on in the marketplace? You know, let's say you are looking to start a restaurant. Okay. Well, is there a Chick-fil-A and a McDonald's across the street from you, right? What's your competition? What's the economic conditions, right? Now, for example, if you're looking to start a daycare center, boy, I tell you, a lot of organizations are really, when I say organizations, banks and credit unions, CDFIs, they love to see great business plans and financial projections with the appropriate experience and capital and capacity for daycare centers right now because that is exploding in demand, right? If you're looking to build a gas station, a real world example that we're working on right now, working with a client that is looking to buy the gas station they're currently leasing and want to expand it, looking for a fair amount of capital to outsource, to add more pumps and trucks and those sorts of things. Conditions for that particular project are great because there isn't a Circle K or a 7-Eleven close by. The nearest gas station for this particular client on either side of the road is in excess of 10 miles, and there is a lot of traffic going down this state highway every single day. Financial institutions are really interested in that because, boy, that makes a lot of sense. So we're working on that business plan for that particular client, you know, right now. Right? So a lot of it, you know, when banks are looking at the conditions, it's, you know, what's the economy? What's the competition? So on and so forth. And then finally, it's confidence. You know, what is the lender's overall confidence in you, the small business owner or owners? that you're going to be able to do everything that you say you're going to do, right? And a lot of it has to do with how is your interaction? Are you professional? Are you responding to emails and requests for information on a very timely basis? What's been your experience with this particular bank? Do you have, are you currently a customer with this bank? Do you have overdrafts in your account? So on and so forth. So as banks look at the six C's of lending, the top right, your credit score, your character, and your confidence are probably the two biggest things that they're going to be looking at, as well as all the other four: capital, capacity, collateral, and the economic conditions as well. It's a holistic view. Okay. The other one is, as we talk about on the personal side, FICO, just a couple things there. FICO score ranges from 300 to 850. A year ago, the average FICO score for individuals throughout the entire state of South Carolina was 699. As I mentioned earlier, uh, most financial institutions are going to require 650 or higher. Some may go a little bit lower. The vast majority are going to be looking at that 650 to $700, 650 to 700 range. 65% of your score is based upon your payment history and your credit utilization. We would encourage you, if you're not doing this already, to find out what your credit score is. And you're allowed one free credit report from the credit bureau from annualcreditreport.com, and certainly you should do that if you haven't already. On the business side, it's not really used all that often, especially for small businesses. Banks may take a look at it, but many of the banks that I have talked to in working with small businesses that are existing, they really don't pay that much attention to it. It's more so on the personal side. That does not mean that you discredit it completely, but understand that most banks, whether are going, for companies that have been in business for, let's say, 3 years or less, more so are going to be looking at the personal. All right, let's move on to one of my favorite topics. The numbers, the big three. So, curious as whether or not how well you know what the big three are, right? And how does it actually work, right? So, what is the big three? Well, they're the financial statements, right? What are they? In very simple terms, it's a written record that shows the business activities or the financial performance of a company. Right? Very simple terms. They're numbers. It's a picture of a company's health at a point in time or over a period of time. And they need to conform to what's called GAAP, generally accepted accounting principles. The big three, if you don't know, are one, the income statement, which shows your sales, your revenues, your cost of sales to produce that product, your expenses over a period of time, and whether or not you're in the black. Are you making money, or are you in the red? Or are you losing money over a specific period? Income statements are also, commonly referred to as a P&L. Your balance sheet, which lists all of the assets that you own. Think about it for a business. How much do I have in cash? Accounts receivable. Customers owe me money for products or services that I've sold. Your inventories, right? Fixed assets, computers, equipment, furniture, trucks. And then what are your liabilities? Liabilities such as accrued payroll expenses, accrued expenses for utilities or credit cards, insurance, taxes. What debts do I have? Long-term debts, equipment loans, truck loans, real estate loans. And then how much do I own? Right? Assets minus liabilities is your owner's equity. And then cash flow is the third one. The cash flow statement is honestly a statement that can be quite confusing. The vast majority of business owners really don't understand how cash moves in and out of the business. And that is something personally I spend a lot of time on with clients that I work with, both startups and companies that have been in business for 10 years or more, to make sure they have a good understanding of how cash is moving in and out of a business. A business can make money or can lose money for a long period of time and still operate. However, it's not going to be able to be in business if it runs out of cash. Okay. Few terms and conditions, and again, we will be sending this to you as a PowerPoint as well, of assets. Okay, what do I own? Right? As I mentioned before, cash, inventory, land, buildings, furniture and fixtures, and so forth. What are my liabilities? Who do I owe money to? Could be Uncle Sam for taxes, salaries to your employees. Do I have withholdings to the federal government, property taxes, so on and so forth? The difference between assets minus your liabilities is what is the company, what's the net worth of the business on paper? Not necessarily what it's worth, but what is the net equity of the business? Think about it as in this terms. If you're starting a business, you've got zero assets, zero liabilities, and honestly, zero equity. But now let's say you put in $25,000 of cash in the bank, right? You've got assets of $25,000, and now you have owner's equity. You're skinning the game of 25K. Again, think about it this way. What you own minus what you owe is what it's worth. Some income statement definitions. Revenue, often referred to as sales. What is, or the top line? Money generated from selling or providing goods or services. Your cost of goods sold, which is the direct cost of producing those goods. So let me use a t-shirt example. Let's say you have custom t-shirts. Your raw materials are going to be the t-shirts themselves. It's going to be ink. It's going to be screens. Your direct labor of your employees to produce that, certain, direct overhead. And then what is your gross profit? Which is simply revenues minus cost of goods sold is your gross profit, after your cost of goods sold. And then you have your operating expenses, fixed and variable expenses on your P&L, your salaries and your wages, your rent expense, insurance, marketing, advertising, so on and so forth. And then net profit or income, right? What's the bottom line? Typically, excuse me, oftentimes you'll hear, is the company in the black or is it in the red? Black means you are generating a profit or income. Red means that you have a deficit or an operating loss. A few others kind of on the balance sheet. Retained earnings. From the day that you start your business or you form your LLC, you track historically how much profit or loss does the company have from the moment in time to the current event. One of my best friends is the president and chairman of the Dow Chemical Corporation in Midland, Michigan, where I used to live. Dow Chemical has been in business for over 100 years. Their retained earnings is accumulation of 100 years of profits and losses over that period of time. Okay? Accounts receivable, money that customers owe you for goods and services that you have delivered but you have not yet been paid. Accounts receivable are just the opposite. Money that you owe for goods and services that you have not paid your suppliers for as of yet. Then there's terms depreciation and amortization. So let's say you bought a truck for your company. On your financial statement, you don't expense that, let's say $40,000 vehicle the day that you buy it. If its useful life is, let's say, 7 years, depreciation is that you will deduct that on an annual basis for 7 consecutive years. So you take a portion of that $40,000 vehicle investment over that 7 year period. And then there's a whole thing called financial ratios, right? Numerical representations of profitability, solvency, liquidity, and a whole host of others that when we work with you, we develop and put together what are your KPIs, what are your key performance metrics to help guide you through managing and running your business. We also have resources of best practices. So let's say you're a gas station or you're a restaurant. We've got tons of information that we are able to do a compare and contrast. How does your business stack up against national averages, right? What are things that you're doing better or worse than? What are things that you can improve upon to help guide you through that entire process? How much money are you making? What's your return on investment, for example? How much cash are you generating? How does that compare to the national average? We can help guide you through that entire process. So once you launch, or as you look to grow and expand your business, we can provide you with the best tools available. Now, cash or accrual. Geez, that's might be a little confusing, but how does your business operate in terms of when do you recognize income and expenses? Most businesses are on an accrual basis. Okay. What does that mean? I'm going to use the same t-shirt example, right? Let's say you get an order from a customer and you're now selling $10,000 worth of t-shirts. And now here it is May 29, right? And you're shipping that out the door. If you're an accrual basis for financial statements, you're recording that revenue on May 29. You're shipping that $10,000 of product out the door. If you're a cash basis for accounting, you're only recording that revenue or that revenue of that $10,000 when your customer actually pays it. Right? And so if they don't pay you in 90 days, you're not counting that as a sale until 90 days from now. 99% of the time, we are going to recommend to our clients that they be on an accrual basis for accounting. We can help you set up your whole accounting system that way. That way, in accrual basis, you are matching up your revenues and your expenses when it actually happens versus later on down the period. Inventory, the raw materials, work in process, and finished goods to make and produce your product. Okay, so let's just talk about go into a little bit of detail of the big three. As I mentioned, the first one is your income statement or your profit and loss. It shows whether or not you are making money and how you are making money. So let's go through this example. Sarah's Bagel and Donut Cafe. Here is their P&L for the years ending December 31, right? And as you see here, in 2022, company had revenues of $175,000, gross margin of 56% or gross profit of $98,000. They had roughly almost $80,000 of operating expenses, had pre-tax income of $18,550. Federal income tax is 21%, and the business made $14,654. Okay. Now let's look to 2023. Revenues increased nicely to $225,000. Boy, gross margins increased by 4 percentage points from 56% to from 56% to 60%. That may not seem like that much. However, that, for example, that 4% increase in margin is $9,000 more profit. Okay. Then you got operating expenses. Operating expenses went up from 79,000 to 95,400. Boy, that's a big increase, isn't it? However, pre-tax income went up nicely to almost $40,000, and after we pay Uncle Sam, the business made $31,284. Again, that is basically what you see as a P&L. Incredibly important that you have accurate and timely financial statements to look at how your business is actually doing. I can't tell you the number of times where, as a statewide organization, companies that have been in business for a year or two or more come to us and say, I need help. And one of the first things we're going to ask for is, please send us your financial statements. Well, I really don't have any. Well, it's very hard for us as business consultants, and we've got a lot of experience of running companies. Most of our consultants throughout the entire state have been CEOs and CFOs and owners, as I have been, of many companies. But unless you have accurate data, it really is hard to provide consulting help. Okay. So it's so important that you have that. Another way to look at an income statement is what's called a common size. And for some reason, oops, let me go to previous. Excuse me. Bear with me here. A common size income statement. Same numbers, but as you see, we have percentages. And this is really important as you look at your business and your business performance over a period of time. That could be quarterly, it could be annually, is what's happening with your business here. So for example, as I mentioned before, take a look at operating expenses. Operating expenses went from $79,450 to $95,400. That's a pretty big increase in terms of dollars, right? However, when you look at that as a percent of sales, it actually went down, right? So your operating expenses went from 45% down to 42%. What that means in numbers is that your revenues increased at a higher rate than your operating costs. And that's what you would want to see over a longer period of time, right? Because if operating expenses as a percent of sales went up, means your profitability is going down, okay? In this particular case, return on sales increased from 8.4% to 13.9%. Sarah's Bagel and Donut Cafe, every number you see here, even though in absolute numbers, expenses and things went up, the bottom line has certainly improved, okay? Next is your balance sheet, right? As I mentioned before, what does the company own? What does the company owe? And simply a mathematical formula, total assets minus total liabilities equals your owner's equity, okay? And as you see here in this particular example, assets are improving nicely. Total liabilities are growing, of course, as you see that you took out an equipment loan, an additional net of $7,500. But those are the sorts of things that you want to make sure that you have accurate records, both from an income statement as well as on a balance sheet, so you know where your business stands at any one given point in time.
Hey, Rick, we've got a question that
Sure.
I don't want to let this one sit. Do we have a program we can recommend that can capture this automatically or manually?
There's a lot of software packages out there. our go-to that we would recommend would be QuickBooks Online. It is a cost. Sometimes we might be able through the SBDC to get a client a bit of a discount over the going rate. Um, but QuickBooks Online does a very, very good job of the whole dual accounting systems for small businesses. We have several consultants within our SBD team here in the state that I use extensively, both myself and co-consulting with our clients to help them set up their accounting system. There are some, and I want to be careful about this. There are some no cost online accounting systems out there. I'm not going to name them.
You get what you pay
However,
for.
we have had some difficult experiences when clients have come to us because it just doesn't do a very good job. QuickBooks really is probably the cream of the crop right now.
And we have a QuickBooks class that you can sign up for. That is
Yes.
actually, someone just said, is there an SBDC class for setting up QuickBooks Online? We have a QuickBooks class that is regularly available. We have one of our counselors is, I don't know a better way to describe him other than like king of the QuickBooks.
You're talking about Brent.
I'm talking about Brent. He does a
Absolutely.
tremendous job.
I work with Brent extensively.
Yes. So, what I'm going to do is I'm going to put the training page in the chat in just a second, and you can scroll down to it's like business financial help. We have them in carousels. And so you can actually go in and watch one because I don't think we have one set up for next month, but we typically Brent gives them, 2 or 3 times, gives this class 2 or 3 times a year, and it's a great class. So
Yes.
I'll send that out in just a second.
Yeah, and again, Emily, with that, if you're in business today or you're looking to start and you need some help along the lines of QuickBooks, sign up as a consultant, and I or one of our other consultants, either through the SSBCI program or our core program, be very, very happy to help you getting your accounting systems set up in the correct manner as early as possible. It is very, very important. All right. And then let's talk about cash flow. Cash flow statement really depicts how cash is moving in and out of the business. Just because you're making money does not mean that you are generating positive cash. Right? Think about it from the standpoint of, let's say you're selling your products to your customers and it's all accounts receivable, meaning you're waiting for them to pay you. Well, you may have a great month or a couple months of sales, but you could really be struggling from cash if they're not paying you until 60, 90, or 120 days from now. And the cash flow statement helps to show how money is moving in and out of the business. Not going to spend really much any time walking through this particular example, but it's just the importance of knowing how that works, and we can help guide you through that process. I'm going to give you a real quick example. The importance of cash flow and understanding your cash flow. I was working with a startup company in Michigan about a year and a half or so ago that was launching this business. We were able to get them $200,000 of equipment loan with about $35,000 of owner's equity, a little bit less than we thought would be required because the bank was really excited about it. And I kept on asking the owner and the ownership group, what are the terms and conditions from your three major customers? How are they going to pay you? And it took a long time, but they finally got the information from a couple of two of the three large customers. And they said we're typically going to pay you in 90 days, but for your cash planning, better plan on 120. Okay. My client didn't think that much of it. it threw up huge red flags because this was a business that had contracts that were going to generate about $30,000 of revenue per month. Okay. So think about this. What's 30 times $30,000 times four? That's $120,000. So they were going to have $120,000 in receivables on their books. Boy, they're showing sales, right? But they're not getting that cash until 4 months later. By us depicting all that through detailed cash flow, we were able to go to the bank and get a line of credit that they could draw on to fund that until they were going to be paid. Honestly, if they didn't have that line of credit, as much time and effort that we put into this whole startup over a 6 month period, they would have been out of business in less than 90 days because they did not have the cash flow, or they didn't have access to cash to fund the cash flow of the business until they got paid. That's why it is so important that you as a business owner, whether you're starting up or for those that I'm sure that have been in business for several years, know the importance of having good cash flow and good cash flow management. Okay? We're going to send this out to you as well, a whole host of financial ratios from gross profit, gross margins, working capital, debt to equity. We're not going to go through those for the sake of time today because our time is almost up. But I do want to wrap up by saying this. Don't be shy about asking help if you need it or when you need it. Our mission in life is to help small businesses just like yourself grow and succeed. You want to perform your needs assessment. Again, we can help guide you through that process. Check your credit score on a routine basis. Make any repairs or improvements if you need it. Update and review your financial statements and your business plan. Again, we can help you with that. Right. Know what your loan request is going to be. Again, we're here to help. Understand what is your cash flow. And we'll help you determine if traditional or non-traditional financing or combination is both. Hire an attorney. Don't get into any loan agreement without fully understanding all of the terms. Plan ahead. If you're looking to get a loan in the next 20 days and you haven't done your business plan, you haven't done your projections, you haven't gotten all of your documentation ready, it's a little too late. You really need to be very proactive and plan ahead. And with that, our time is pretty much up. It's just about noon. If we can answer, maybe a few more questions. Here is how you can work with us. And again, everything is no cost. Sign up. Many of you, obviously, if you're here, you are signed up for training. If you would like some consulting help, we can help guide you through that process. A business consultant will be assigned to you. It may take a few days to process in our system, but once one of our SSBCI clients get that information, we'll be in touch within a few days and set up an initial consultation within a week.
Okay, Rick, I've got a question from the chat. I didn't get it to it earlier. I'm so sorry. I want to get a loan, but I don't want to put my house as collateral. I do have a good personal and business credit score and could come up with a solid business plan. What loans could I consider without collateral requirements?
Well, if you have a strong financial position, a bank may not require a personal guarantee or collateral.
Okay. I think that is it in terms of questions. We've kind of been
Okay.
answering as we've gone on. There are several links in the chat that you can click on. If you have any questions, please feel free to reach out to Rick or to me, and we will get you where you need to go if we can't
All
get
right.
answers.
All right, everyone. Thank you so much for your time. We certainly look forward to working with you in the future and have a blessed day. Take care.
Thanks so much. Oh, and real quick, we will be sending out a survey. So if you could please fill that out. It helps us with our programming in the future. There is one more comment. It says the credit profile needs to be optimized. The score is not as important.
Right.
And I've got another question. Should we be concerned about changes that are forthcoming with the SBA with all the changes in government?
We are on top of that. We get updates from our state office on a regular basis. At this point, we're in very, very good shape. Also, our SSBCI team is largely funded through the Department of Treasury, and we are just starting year two of a 5-year guaranteed grant. So our funding is in a very good shape for the long term.